Warren Buffett is universally regarded as the greatest investor of all time. Since purchasing a struggling textile manufacturer in 1965 named Berkshire Hathaway, he has turned Berkshire into a successful holding company worth more than $600 billion today. Berkshire Hathaway's stock price has more than doubled the return of the S&P 500 index since Buffett took over. Given the magnitude of his success, you would think Buffett has made hundreds or even thousands of successful investments as CEO. However, the majority of his results can be traced back to just a handful of investments. In this video, we're going to dive deep into 5 of Buffett's most successful investments, and most importantly, learn from his thought process to improve our own investing knowledge and skill. These 5 successful investments have combined returns of over $250 billion for Buffett and his fellow Berkshire Hathaway shareholders. Before we get started with the analysis, I just have to say Buffett is personally one of my favorite investors to study. I am a proud shareholder of his company, Berkshire Hathaway, and have gone to his annual meeting in Omaha, Nebraska. I try to learn from his experience to replicate his investing framework in my job as an investment analyst for a large investment fund in New York City. On this channel moving forward, I'm going to be incorporating my own knowledge and investing skills from my job as a professional investor in order to help you become a better investor yourself. All that I ask for in exchange is to like the video and subscribe to my channel if you find this information useful and helpful. Without further ado, let's dive deep into the analysis. Anyone who follows Warren Buffett knows that he has avoided technology stocks throughout his entire investing career. He has repeatedly said that the rate of innovation inherent in technology companies makes it difficult for him to reasonably estimate the operating future of the company with a high probability. That is why it came as a surprise to many in the finance community when Buffett decided to buy Apple stock in 2016, first buying 10 million shares of the company. He has since gone on to add to that stake, eventually investing more than $36 billion in the tech company's shares. That stake, including the $11 billion in shares he has cashed in last year and the over $3 billion that Berkshire has collected in dividends, was worth about $134 billion at the end of 2020. This means that Berkshire has made nearly $100 billion on its stake in the company. Apple shares have slid slightly in 2021, but are still up an impressive 400% in the past 5 years. Berkshire now owns just over 5% of Apple, which currently has a market value of greater than $2 trillion, making it Buffett's largest investment in any publicly traded company. At $120 billion, Berkshire's stake in Apple equals about 40% of its overall stock market portfolio. Buffett is quick to point out that he considers Apple more of a consumer goods company as opposed to a pure technology company. Buffett is a big fan of companies with strong brands and loyal customers. Apple fits that description pretty well. 3 years ago, Buffett told CNBC that he believes the average person's connection to the iPhone was strong enough that most people would pay much more for the device than they currently do. I focus on the hundreds of millions of people who practically live their lives by the iPhone, Buffett said at the time. I have a plane that costs me a lot, $1 million a year or something of the sort. If I use the iPhone like all of my friends do, I'd rather give up the plane than the iPhone. Another key criteria that is important to Buffett in his investing approach is that he focuses on the quality of the management. He wants a management team and CEO that is focused on creating long-term shareholder value. Prior to making his investment, Buffett said he never spoke to Apple's CEO, Tim Cook. However, he frequently read Apple's annual report and 10K to truly understand the company and how Tim Cook ran the company. Buffett has been very complimentary of Tim Cook, saying Tim understands the world to a degree that very few CEOs I've met over the past 60 years could match. That is very impressive coming from Buffett, who has met some of the best CEOs in the world over his long and storied investing career. Take a listen to Buffett talk about Tim Cook in this clip.
In his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at 2 great ones on both ends here. He's handled that business so well. He couldn't do what Steve Jobs obviously could do in terms of creation, but but Steve Jobs couldn't really, I don't think, do what Tim Cook has done in many respects.
Next on the list is Geico, which stands for the Government Employees Insurance Company. It is now a wholly owned business of Berkshire Hathaway, but it wasn't always that way. In fact, Buffett's history with Geico goes all the way back to the 1950s, even before he owned Berkshire Hathaway. Geico first came across Buffett's radar when he was still a business school student at Columbia under his professor and future employer, Benjamin Graham. In 1951, Buffett went down to Geico's offices on a Saturday, where the janitor let him in. The only other person working that day was Lorimer Davidson, who would later become the CEO of the company. Davidson agreed to meet with Buffett and generously explained that both the insurance industry and Geico's special competitive advantages. Geico was set up in a unique way for an insurance company, bypassing traditional agents to sell policies directly to consumers. In addition, Geico targeted only high-quality drivers such as government bureaucrats and professors. By selecting its market segment and not having to pay agents commissions, Geico was able to offer car insurance at a huge discount to other insurers while still earning a superior profit margin. Never being much of a fan of portfolio diversification, Buffett subsequently put half of his net worth into Geico stock. Buffett would make a quick 50% return in just over a year before selling his Geico stake to put the profits into a cheaper stock. That would prove to be a mistake, as the value of Geico stock rose nearly 100 times over the next 20 years. That taught me a lesson about the inadvisability of selling a stake in a wonderful company, Buffett said in his 1995 letter to shareholders. However, 25 years later, Buffett got another chance to buy Geico, this time acquiring Geico stock for his holding company, Berkshire Hathaway. In a stunning turn of events for such a competitively advantaged company, Geico almost went bankrupt in 1976. By then, Davidson had retired, and the new executives running the company started to vastly underestimate Geico's claim losses resulting from inflation. They then tried to fix the problem by growing out of it, relaxing the company's premium to surplus ratio, or the amount of premiums in relation to equity, and growing out of its niche business of high-quality drivers. That only wound up making things worse for the company. Losses soon grew, and by 1976, Geico was on the edge of bankruptcy. By then, Buffett was on the board of directors, having taken over from Jerry Newman, partner in the Graham-Newman partnership, which had been a large investor in the company. Buffett then helped recruit a new CEO to come and fix the mess. With the belief in the new CEO's abilities and Geico's main competitive advantages still being intact, Buffett pounced on Geico's distressed share price, buying $4 million in Geico common shares and another $19 million in convertible preferred stock. Once installed, the new CEO took emergency measures, firing over half the company's employees, exiting unprofitable markets, and raising premium prices. These actions worked, restoring Geico's profitability in the very next year, and Buffett's investment was off to the races. By the end of 1977, Buffett's common stock had increased 150%, and even the value of the preferred stock had nearly doubled. Buffett added even more to his Geico holdings over the next 4 years, and by 1980, he had invested $45.7 million in total, good for roughly 1/3 of the company. With Geico restored to its former glory and its low-cost advantage intact, Geico continued to both grow and buy back stock throughout the 1980s, which increased Berkshire's ownership stake to 50% of the company without a need for Buffett to buy any more stock himself. At the end of 1995, Berkshire bought out the remaining 49% that it didn't already own for $2.3 billion. That meant Berkshire's initial $45 million stake had grown to be worth a stunning $2.4 billion at the end of 1995, just before the deal closed. Good for a ridiculous 5,000% gain in just over 15 years. That's over a 30% annualized return starting from 1980 when Buffett attained his full stake. From 1976 on, the return was even higher. Today, Geico is one of the most important subsidiary companies of Berkshire Hathaway, with some estimating the value of the business at over $30 billion. Third on the list is BNSF, arguably one of my favorite Buffett investments of all time. In 2009, Buffett's Berkshire Hathaway bought the remaining 77% of Burlington Northern Santa Fe, the nation's second largest railroad, that it did not already own, in a deal worth $44 billion. Buffett started purchasing shares of the company in 2007 and had built up a stake of over 20% of the company before he decided to purchase the remaining shares and the entirety of the company. Buffett considered this purchase an all-out bet on the future of America. One of 9 North American Class 1 railroads, BNSF has 41,000 employees, 32,500 miles of track in 28 states, and more than 8,000 locomotives. It has 3 transcontinental routes that provide rail connections between the western and eastern United States. BNSF and its chief competitor, the Union Pacific Railroad, have a duopoly on all transcontinental freight lines in the western U.S. and share trackage rights over thousands of miles of track. Buffett liked BNSF so much that he did something that he strongly dislikes and rarely does: issue stock in Berkshire Hathaway to fund an acquisition. The total consideration consisted of $15.9 billion in cash and $10.6 billion of newly issued Berkshire common stock. Berkshire raised approximately $8 billion in debt at the corporate level to fund the cash component of the transaction, along with an equivalent amount of cash on hand. In the 2009 Berkshire Hathaway annual report, Buffett said, In the end, Charlie and I decided that the disadvantage of paying 30% of the price through stock was offset by the opportunity the acquisition gave us to deploy $22 billion of cash in a business we understood and liked for the long term. Warren Buffett has frequently said that his favorite holding period for an investment is forever, so it should come as no surprise why he would like a railroad. BNSF's history dates back to 1849. The railroad has been in business for more than 150 years and will likely still be in business 150 years from now. While shifting consumer preferences and technological advancements will change what products and materials the railroad will be moving, you can count on the railroad will still be used to move whatever products and commodities are needed by consumers and the economy at that point in time. While BNSF is a wholly owned subsidiary of Berkshire Hathaway and no longer trades separately on an exchange, some analysts' estimates have assigned a value of nearly $200 billion for BNSF. This is nearly 5 times what Buffett paid for the company just over a decade ago. BNSF's biggest competitor, Union Pacific, has a market cap just shy of $150 billion as of the production of this video. The reason why I like this investment is the simplicity of the business model. It doesn't take a genius to really understand the economics of a large railroad. Even with that being said, Buffett had the ability to focus on the long term and buy a great asset at a discount with this investment. That decision has paid off well, with the estimated return of this investment easily over $100 billion. Next up on the list is See's Candies. While this investment hasn't brought in tens of billions of dollars for Buffett, like his investments in companies such as Apple, Geico, and BNSF, Buffett's investment in See's Candies has had quite an impressive return on a percentage basis. Berkshire acquired See's Candy in 1972 for $25 million. In today's money, that'd be worth just under $155 million. See's Candies is an American manufacturer and distributor of candy, particularly chocolates. At the time, See's was earning around $4 million annually before tax, just under $25 million in today's dollars. So Buffett and Munger paid roughly 6.25 times earnings for the business. They were essentially betting that See's Candy would continue to be profitable, if not more, 10 years down the line. Fortunately, that bet paid off. By 2017, the business had earned Berkshire around $2 billion, or 80 times the money that it had been acquired for. Arguably more important than the money See's Candy has made Buffett is the lessons it taught him. Prior to buying See's Candies, Buffett was known for his cigar butt approach to investing, where he would buy struggling companies that were selling so cheaply that he could make money on the investment as the company was liquidated. Buffett compared this approach to cigar butts, where if you pick up a discarded cigar butt on the street, you would only get one puff left of it, but at least that would be free. The See's Candy investment marked a turning point for Buffett, where he transitioned from buying poor businesses at a great price to buying great businesses at a fair price that could compound returns for decades. See's is the epitome of that kind of business. Listen to this clip of Warren describe the economic characteristics of the business.
You can go back to the first, wasn't the first outstanding business we bought, but it was kind of a watershed event, which was a relatively small company, See's Candy. And the question when we looked at See's Candy in 1972 was, would people still want to be both eating and giving away that candy in preference to other candies? And it wouldn't be a question of people buying candy for the low bid. And we had a manager we liked very much, and we bought a business that was paid $25 million for it net of cash, and it was earning about $4 million pre-tax then, and we must be getting close to $2 billion or something like that pre-tax that we've taken out of it. But it was only because we felt that people would not be buying necessarily a lower price candy. I mean, it does not work very well if you go to your wife or your girlfriend on Valentine's Day, I hope they're the same person, and say, here's a box of candy, honey, I took the low bid. It loses a little of it as you go through that speech. And we made a judgment about See's Candy that it would be special, and probably not in the year 2017, but we certainly thought it would be special in 1982 and 1992, and fortunately we were right on it. And we're looking for more See's Candies, only a lot bigger.
Selling candy is a pretty straightforward business, which makes See's the perfect example of Buffett and Munger's core beliefs, that investing is about putting some amount of money down today in order to secure a larger amount of money in the future. It is interesting to note that Berkshire almost missed out on See's Candies. Buffett said at the 2017 conference that he wouldn't have paid much more than the $25 million for it back in 1972, although he is quick to point out that his business partner, Charlie Munger, would have, remarking, "If it had been $5 million more, I wouldn't have bought it." Of course, with the benefit of hindsight, paying $5 million back in 1972 for a cumulative total return of $2 billion in earnings by 2017 would have been a no-brainer decision. Number 5 on the list is Coca-Cola. Warren Buffett may be best known for his investment in Coca-Cola, one of the most iconic brands in the world. He bought more than $1 billion in Coca-Cola shares in 1988, an amount that was equivalent to 6.2% of the overall company. The purchase made it the single largest position in Buffett's Berkshire Hathaway portfolio at the time. While Berkshire's portfolio of companies has grown substantially since the 1988 purchase, Coca-Cola remains one of the largest positions in Berkshire's portfolio, more than 30 years later. The position is currently worth nearly $22 billion. But what made Buffett buy the stock when the stock was still reeling after the 1987 market crash? And why has he held on for so long? The stock market crash of 1987 created some attractive opportunities for long-term oriented investors, as all stocks were sold off with little regard to their fundamentals. Coca-Cola was an example. It was, and still is, the dominant company in the beverage industry. With over 500 unique brands selling in nearly every country of the world, it is truly a global company. Coca-Cola's iconic name, strong brand recognition, and global reach create a moat around its core soft drink product. A successful consumer-facing business builds the name recognition, the distributor network, and the retail relationships that protect it from encroachment by competitors. Buffett understood that no competitor was going to appear and take away Coca-Cola's market share and dominant competitive advantage. Coca-Cola's moat has continued to expand over the years as the company has steadily absorbed potential competitors and expanded into new trends through purchases such as vitamin water, green tea, and Dasani waters. Listen to Buffett describe Coca-Cola's brand power and his investment rationale in this clip.
Coca-Cola sells half, roughly, of the soft drinks in the world, and soft drink consumption per capita goes up basically every year, and the per capitas go up. I mean, the capitas go up every year also. So you get these gains. Maybe they're 3% or 5% in units or 4%. It was 5% in the first quarter, but it was poorer than that. I think it was 3% last year. But you know, when you have half the world, and the world's population is growing at a little under 2%, and you're getting 3 or 4% from something that's as pervasive as soft drinks, you know, you're doing all right.
Buffett's investment in Coca-Cola also demonstrates the power of one of Buffett's favorite investing concepts, share repurchases. Over the ensuing decade since his initial investment, Coca-Cola has used the cash the business has produced not only to pay healthy dividends, but also buy back stock and reduce the number of shares outstanding. This means that there are less shares outstanding of the company, and as a result, each share represents a larger ownership percentage of the company. This is the reason Buffett's original 6.2% stake in Coca-Cola has grown to 9.3% without purchasing any additional shares. Berkshire is now the single largest shareholder in Coca-Cola. It's safe to assume Buffett won't be selling anytime soon. So there we have it. These 5 investments helped Buffett produce over $200 billion in returns. What are the key takeaways we should learn from these investments? There are many, but here are my 3 favorites. 1. Focus on the long term. 2. Truly understand the economics of the business you are investing in. And 3. Buy businesses with strong competitive advantages. Thank you for watching. I hope you found the information useful and relevant. Talk to you soon.